In video lecture 3-3, we're going to begin our tour of the balance sheet, and we're going to start by describing how assets are presented on the balance sheet. Here is the asset portion of the balance sheet for Lowe's Company, the home improvement store. And again, let's take a second to read the definition of an asset. Again, an asset has to have future value. It has to be controlled by the entity as a result of something that has occurred in the past. Here we begin our presentation of assets by presenting current assets first. We lead off with cash and then present our remaining current assets in order of liquidity. And liquidity means that we convert a non-cash current asset into cash. So short-term investments can quickly be converted into cash if they're traded on an open market. If Lowe's owns stocks and bonds of other companies as an investment, and they're traded on an exchange, they can quickly be converted into cash by calling up their broker and selling. Lowe's main operations, of course, is to buy merchandise inventory and then resell it. So the liquidation of inventory would occur when a customer comes in and purchases the merchandise. It really does not matter to Lowe's whether that sale is in cash or credit card. Since the credit cards are being operated by the bank, Lowe's will receive the cash for that sale in a relatively short period of time, typically only a day or two. Other types of current assets will never actually be converted to cash, but in essence will be consumed. Think about prepaid rent. If Lowe's prepays rent on one of their store facilities, well, it'll start as an asset. As time passes through the year, it will be consumed by the recognition of rent expense for the portion of the year that the prepaid asset was used. Lowe's will then present the total current assets, a subtotal of all our current assets. They'll then present the long-term assets. Typically, the operating assets are presented first, property, plant, and equipment. Again, notice here it's presented net of accumulated depreciation. Later on in the annual report, if you were to read it, you would see the historical cost of the property and the amount of accumulated depreciation by categories of property. Here we see Lowe's has certain investments that are being made that they do not plan on using or converting to cash within the next year. They plan to hold these for longer than 1 year. And these can be strategic investments. And we'll talk more about the difference between a short-term investment and a long-term investment in Intermediate 2. Let's begin by looking at some current assets. Again, our definition is that current assets will be converted or consumed within 1 year or an operating cycle, and we'll take a look at what that means in a second. And our typical current assets are things like cash, cash equivalents, short-term marketable investments, accounts receivables, inventory, prepaid expenses. The textbook has examples and definitions for each of these, but you can also go to the source document or authoritative source, and that is the FASB codification. Balance sheet presentation is presented in topic 210. In 210.10.45, they talk about the presentation issues for the balance sheet and see that it begins with the classification of current assets. We have a quick link to the glossary and the definition of a current asset. We talk about cash. That's cash from bank accounts, savings accounts, money markets, cash on hand, and cash equivalents. And we see that a cash equivalent is a short-term, highly liquid financial instrument such as a T-bill or commercial paper. The rules on cash equivalents we will review in Intermediate 2, but for now you should know that cash equivalents have a maturity date of 90 days or less. So we have various types of inventories. Merchandise inventory like Lowe's would have. Manufacturers will have raw materials, goods in process, finished goods. We could have operating supplies, indirect materials, etc. We'll be talking more about these other types of inventories and how costs move through the accounting process in our next class on cost accounting. And then the code will give definitions and examples of other current assets. Again, when we talk about an operating cycle, what do we mean? Well, the code definition of an operating cycle is the time interval between when we acquire material and services and the time that we actually receive cash from the sale of a good or service. Typically, companies use a 1-year time period because their operations are varied. They may have several types of operating cycles, but there are some specific industries such as distillery. If you think about wine or liquors, it takes an aging process between the time that a beverage is distilled and when it actually is sold to the public. For our purposes, we will solely be using a 1-year time period as our operating cycle. Anything that is not a current asset, by default, is a non-current asset. And this is our property, plant, and equipment. We do not expect to convert or consume these within 1 year. We could have other types of investments, strategic investments that we're going to make that we plan to hold on to. Again, we'll be discussing these items, investments, property, plant, and equipment, intangibles, other assets in greater depths in Intermediate 2. But for right now, you need to know if it's not a current asset, it is a non-current asset. And that is our lecture on the presentation of assets in the balance sheet.